Welcome to Warwick Business School's Core Insights podcast on FinTech. This is the first in a series of podcasts on FinTech with the school's Gillmore Centre for Financial Technology. In this series, together with the help of the Centre's world-class researchers and professors, and alongside guests from the FinTech industry, we're going to be exploring the big issues as the financial sector continues to grapple with disruptive technologies. My name's Natasha de Teran, and I'm your host. I'm a former financial journalist and writer, author of The Payoff, How Changing the Way We Pay Changes Everything. I'm going to be asking the questions to find out just where FinTech is heading. Today, we're going to ask, how will central bank digital currencies impact our world? To answer this, I'm joined by Ganesh Viswanath Natraj, Assistant Professor of Finance at Warwick Business School and part of the Gillmore Centre, and Jeremy Leake, a Senior Advisor, CBDC and FinTech at the Bank of England, himself also an alumni of Warwick. To me, CBDC are one of the most exciting things that may or may not happen in finance, and the most ignored, I think, outside the financial sector. What you think a CBDC is for?
I should add that I'm speaking in a personal capacity, but nevertheless, I'm a Bank of England employee. The work on central bank digital currency at the Bank of England, it's been undertaken as part of a joint task force with the government. I should say that at the start. So there's a joint oversight of work on central bank digital currency. And it's interesting that the first thing that they say is they conclude that they are not yet at a point when a firm decision can be made to implement a digital pound. That implies there is no burning platform to implement one if one was asking to do it today. The task force explains that there's a forward-looking assessment for central bank digital currency, given the lead time that one would need in order to implement one. And this assessment is that on current trends, it is likely that the retail general purpose digital central bank currency, or what is being called digital pound, would be needed in the UK. And this would be a new digital form of money issued by the Bank of England for use by households and businesses for everyday payments. The important point I'd like to relay is that this is a forward-looking assessment, that it will take quite a considerable amount of work in order to actually launch one, and that one needs a lead time.
You mentioned there that it's a new form of digital money.
In the bank, we call digital money basically forms of money that you would use in everyday use. Digital forms would include bank deposits, for example, and in the future, possibly a central bank digital currency. All of them would be sterling. All of them are exchangeable, one for one, and you wouldn't really take much notice of which particular form of sterling you were holding. Some might have uses for different forms. So, for example, you can't use cash online, obviously. You need digital money for that. So digital money is interoperable and they're exchangeable one for one. And that is different from other forms of what people might be aware of digital currencies. Digital currencies vary all the way from the likes of Bitcoin, unbacked crypto assets, which fluctuate wildly in value and aren't particularly useful for payments because of that, all the way to stable coins, which look a bit like digital money, but they fluctuate too because they're trading in the secondary market. So they don't always exchange at one for one.
But Ganesh, you and the Gillmore Centre, and you in particular, have been looking very closely at CBDC. What's the point of one from your point of view?
So I agree with Jeremy that, it has these benefits of kind of moving away from a cashless society. So I think that's kind of one of the motivations is kind of declining role of physical cash. And so having kind of this interoperability, so this ability to have essentially moving your physical cash into like kind of the online payments sphere. And I also think that it gives kind of a potential additional tools to the central bank. Of course, this depends a lot on whether there's an interest rate on the CBDC. But in principle, it gives essentially more potential for the central bank to sort of increase the effectiveness of monetary policy if you have now like an additional source of money in the economy. And I think that part of the motivation is also trying to, increase kind of universal access to money as well. So the agents that don't have access to banking services could still use sort of a digital CBDC as an alternative. Surveys in the UK suggest that up to like 1.2 or 1 to 2 million households don't have access to banking services. So it's a kind of an alternative to banking services to have a CBDC. The other motivation could be currency competition as well. So Jeremy mentioned these kind of private competitors like stable coins. And I think that having CBDCs could essentially be a direct competitor to some of these private alternatives. In principle, it should be safer as well because it's backed by the government reserves as opposed to stable coins that often can be backed by commercial paper or other sort of assets that may lose value, and so causes the stablecoin to fluctuate.
Can I pick up on the sort of financial inclusion aspect that you brought in there, the 1.2 million households without access to a bank account and the potential need for a risk-free form of cash in the digital sphere. If I understand it correctly, the bank would not be providing the sort of front end, the app on my phone or the wallet itself. So how would the bank ensure that there was actually universality of access? Because generally speaking, I think the types of individuals that would fall amongst the 1.2 million households are not banked for a variety of different reasons. But one of them is will often relate to the lack of commercial incentive for the providers to actually reach them.
I should be clear about the UK's focus, which is a subset of the things that Ganesh mentioned there, which I know have been talked about more widely. So there have been two main objectives or motivations in the UK for central bank digital currency. The first is, and this is quite a hard concept, but it's actually the uniformity of money. And it's a concept that we just take for granted at the moment because we just accept that payments are a pound is a pound and it will be exchanged and that's it. But in a future world, particularly with declining cash, that lack of sort of anchor, for example, you could call cash, that you could find new forms of digital money that weren't quite as interoperable as current forms of money. We see this lack of interoperability in other spheres, for example, social media. Even if you just switch on your smart television, you try and search for a television program and you find that you can't find what you're looking for because it's on a channel that you haven't got. There are interoperability issues, and one of the reasons for having a central bank digital currency, particularly with a decline in cash, is to have that interoperability to make sure that you've always got access to a pound and your pound is usable. And so part of the thinking is to make sure we retain that uniformity of money, that interoperability between different forms of cash, so it can play that role. That's a major consideration, particularly with the development of new forms of digital money. A second reason is innovation. Potentially, if we can generate a new form of very safe money, it's a great platform on which you can then build open access platforms for banks and non-banks to innovate. That also plays a little bit to financial inclusion because you've got different players who provide access to people who might not otherwise gain access. But we don't see central bank digital currency as a silver bullet for financial inclusion. And in part, that is because a lot of people who are not financially included in the UK at the moment either prefer cash or are restricted to cash. So it's the digital element that may be restrictive. Nevertheless, it could have financial inclusion benefits, as I said, because the access to it will be through a wider range of entities. That the form of access, so on your smartphone or a digital wallet, may also give you access, but again, that's going to be limited because not everyone has a smartphone. So there are benefits, but I wouldn't want to overplay those benefits for financial inclusion.
And I take your point on it. You know, it can't be a solution by itself. Nonetheless, if I think about how things work in the UK today, we have basic bank accounts, more or less. And I say more or less, some banks, the larger banks, are committed to or obliged to provide them. They're actually quite difficult to find if you happen to need one. And if you happen to need one, the fact is you might actually not know that they exist. And because the high street banks aren't there anymore, you wouldn't necessarily know where to go and find out about one. But what we don't have is an equivalence in a purely digital sphere. There aren't instruments that are required to be made available at cost or for free to those that might need them, or in a very usable form to those that might not have the same digital skills as others. So one of the questions I would have for you, Jeremy, is how much are you thinking about that when you're thinking about the providers that you're going to have between you and British citizens or CBD digital pound holders, because they might not be citizens? Would you foresee imposing obligations on them similar to those that have been imposed on parts of the banking sector?
It's an option to have forms of I mean, there's been talk of basic bank accounts, and you could have a basic sort of app for central bank digital currency, and that's definitely an option. We've not closed off any routes at this stage, and I should perhaps give an outline of the process that we're going through and where we're at the moment, to give you a sense of when decisions will be taken. We've just come out of what we've called a research and exploration phase. That is basically, what is the motivation for having a central bank digital currency? That was then summarized in a consultation paper that we published in February. We've had responses, many responses, in fact more responses than we've ever had for any other consultation we've done, and we're now sifting through those responses from the public as well as from businesses and industry, and we will publish a summary of those responses. Where that leaves us is going forward now into what we've called a design phase, and the design phase is really looking at a bit more detail, exactly what technology, what kind of requirements would be imposed. So exactly to your question, Natasha, what is it we would actually require for the digital pound? And at the end of that phase, which we expect to take between 2 and 3 years, a decision will be taken on whether or not to actually build digital pounds. I suspect one wouldn't impose minimum requirements on everyone. There's a question of what variety of business would like to enter into the sort of the private sector interface for the digital pound. As you say, for those not familiar with it, that what we've outlined is the Bank of England would provide, if you like, the back end of a central bank digital currency, which is, as a user, you would hold an account at the Bank of England. So it would be central bank money as if it's a pound note. The front end of a central bank digital currency would be the private sector, but they'd be acting as so for those familiar with wallets in the digital world, these would be quite unlike those. These would be called what we call pass-through wallets. The front end, if you like, the wallet providers, the private sector, would not have power over your money, because that would be your money held at the Bank of England. They would provide you access to it. So they're not even acting as custodians to your money. So for those familiar with crypto, who hold crypto in custody wallets, this is not like those. This would be look through into the Bank of England account. Those private sector participants would be providing you access to your money. And then there's a question, as you say, about what requirements we might impose upon those private sector participants. And those requirements will obviously cost them, and they have to have a business model, and we want them to participate. So we have to think about their potential profitability. If they have limited profitability, then there's a question of who will enter the market, and do we want a vibrant market? Yes, we do. And so we'll need to think about the requirements that we impose on them. And so one can think about the sort of benefits for financial inclusion and all the other things you might want, but also there's a cost, which is ensuring that the private sector participate also in the system.
Gosh, there's so many things come up in every answer. It's really difficult to know where to steer the conversation next. But I'm going to follow on the risk-free element and the pass-through nature of these wallets. So much as my pound notes, if I had any, are risk-free, so long as I don't lose or burn them. My CBDC will be risk-free. My pound will always be worth a pound because it's the bank's pound rather than a commercial bank's pound. And most of the time, we don't tend to think, we haven't had cause to think in the United Kingdom about whether our pound is indeed worth a pound and what that pound is worth, not for a good while. But things will change. The introduction of the CBDC does in fact stimulate the thought in the consumer's mind, perhaps, that there is a difference between commercial bank money and central bank money and other forms of digital money. But Ganesh, I want to turn to you with this. How do you see commercial banks competing in this environment? Will we still want to hold deposits with them, or will we want to move all of the money that we can into CBDC?
So this is very topical in this area. So certainly in the academic sphere, a lot of people have been thinking about this question of whether CBDC disintermediates banks. And so there are two sides to this. There's one side who believe that it will result in a crowding out of deposits, and essentially households may substitute towards CBDCs, and that would result in a reduction in deposit base and potentially filter through to bank lending. On the other hand, there are others who say that if there's this deposit competition, then when you have a CBDC as a substitute, that will cause an increase in competition for bank deposits, and that could actually lead to an increase in deposit rates and increase in the supply of deposits. So it could actually encourage kind of more deposit competition in banking as well, which would have kind of opposite effects. Because we still don't have like case studies yet, it's difficult to say whether it will disintermediate banks. But I think that the crucial element here is the interest rate on CBDC. So the Bank of England say there's a zero interest rate on CBDC, in which case it's essentially much closer to physical cash. And in that case, there should be limited sort of substitution between bank deposits and CBDC. So I think to the extent that's the case, I don't think it would cause like significant changes to the deposit base. But another crucial ingredient is this limit on the CBDC. And I think in the consultation, it was £20,000. But of course, there can be a lot of debate about whether this is the optimal amount. And if there's a lot of concern about disintermediation, then you would ideally want a lower threshold. So maybe 5 to 10K as a threshold. But it's also, yeah, it's very difficult to think about these thresholds because we don't know take up, right? I think that's a very interesting area of research. I don't like a lot of questions in economics, there's no real like answer. So it's kind of, it could disintermediate banks, it may not, because it kind of depends a lot on the assumptions of the theories people have.
And I suppose it might also depend on rates, where rates are, because for the last 10 years, it hasn't really been worth moving money into your deposit account. Now it starts to be slightly more compelling, although the banks haven't been hugely fast to raise rates on deposits. But I think we have somewhere like 382 billion sitting around in our current accounts earning nothing, I think, from the bank's recent statistics, which would suggest that we might not care, actually, that we don't earn anything on our balances and CBDC. Jeremy, do you want to come in on this?
Yeah. So Ganesh has described the disintermediation effect very well. So what the risks are. In fact, if people listening to this want to go into it in more detail, we published a discussion paper in 2021 called New Forms of Digital Money. Whilst that looked at, it primarily focused on stable coins disintermediating banks, actually would include CBDC as well. They both would disintermediate banks in a similar way, depending on how the stable coin was backed. So in other words, it'd be an outflow of deposits from the banking system into money that was backed by either central bank reserves or high quality liquid assets such as government bonds. So that's the risk. As Ganesh says, in the consultation paper, we've been very clear that for the UK, we would not remunerate CBDC, so it'd be just like cash in that sense.
Is that or at the beginning?
So for foreseeable future, because it's designed to be an alternative payment device, not as a savings mechanism. So obviously, if you wanted it in the savings market, then you'd want to start paying interest, but it's not designed for that. It's designed for payments. If we were to change our minds on that, or want to change our minds on that, we'd have to go through a whole governance process, and there'd be a consultation following it as well. So that is a pretty firm decision to position it in that way. And as Ganesh says, certainly in the current interest rate environment, that makes it much less likely to get disintermediation or massive disintermediation from the deposit market. But there could well be some, as you say, there are non-interest bearing deposits sitting in the banking system. Those could move out. That said, the banks could increase their deposit rates just a little bit, and that could encourage people just to keep a lot of their money in the banking system. So it's true there could well be an impact on deposit rates, positive for savers. There could also be an outflow, I guess, if in times of stress. So if there were concerns about the banking system, you could get outflows as well. So whilst having an unremunerated CBDC, it means that outflows are likely to be relatively small. You can't guarantee that that they will be small, and particularly in a transition period, which is the thing that we focused on. So there's sort of the way we've thought about it is, let's suppose you were to introduce a CBDC on day one, it starts at zero, then it starts to collect money, and then at some point it reaches some sort of steady state, which will fluctuate a little bit, but will be a transition period before that behaviors will be very uncertain. So we don't know what consumer behavior would be. We don't know what the banking system reaction to that consumer behavior will be. I don't know how much take-up will be. In the 2021 discussion paper that we published that I just referenced, we assumed, but this was just a scenario, not a prediction, that 20% of bank deposits moved into central bank or digital currency or digital money more generally. And the impact on lending rates from that, so if you were to pass that through the banking system, and the mechanism is basically banks' funding costs would go up, and we assume that they would then pass that on through lending rates to borrowers. We found that lending rates might go up by around 20 basis points, so 0.2%, possibly more depending on the scenarios, because there's a lot of uncertainty in that modelling, as Ganesh was pointing out. So not absolutely out of this world, and that was for quite a large amount of disintermediation. And in the current environment, one might expect somewhat less disintermediation than that. So that's the sort of context. But within that, because we can't guarantee anything, it seems prudent to put limits on CBDC, at least in the short run, particularly if one's also concerned by potential impact in stress, so you don't exacerbate bank runs, for example. And there, as Ganesh pointed out, we do have a range. It's not 20,000. We said 10 to 20,000 in the consultation paper. In fact, we also mentioned possibly lower limit of 5,000. All of those options are open, and there's a balance here between managing potential disintermediation from the banking system. And we're not here to protect the status quo of banks, by the way, but on the other hand, the accessibility for users and also the viability of business models that we go returning to the PIPs, the payment interface providers, that we want to provide those services. They also have to make money. They won't make any money on net interest margin, because the money that they hold will be held at the Bank of England. It's not going to be on their balance sheet. So the only way they could make money is through fees of some kind, or through monetization of data. And there's issues obviously around both of those things. People don't pay for transactions at the moment, at least not peer-to-peer. Businesses do pay for transactions, and so there's a question of how the business model would be viable at that end. And so limiting the amount people can hold in the account makes that business model less and less viable. And so that is the balance one's trying to strike between making sure we don't kill off the use case for central bank digital currency by making it too limited, but on the other hand, not making the limits so high as to make banking sector risk too great either. And therein lies the balancing act.
It's a fine one. I mean, I suppose in a way, it's useful that rates are rising, because banks' net interest margins are rising at the same time, and that there are a few banks, I think, have survived solely on these so-called interchange fees. I want to move on or back, if you will, to the fungibility, exchangeability question, and the limits. So if I have a limit on my CBDC wallet, I need transfers in and out of my wallet to be absolutely seamless, so that I don't get overdrawn. Presumably, I can't get overdrawn to the bank in my wallet. So I need money to be sucked in automatically, and I can't go over my balance of 10 or 20,000, wherever it's put. So I don't want the bank to take any surplus. I need it to be whisked away immediately. So to me, this is suggesting that there's going to have to be sideways backwards compatibility and absolutely real-time transferability capabilities right across the United Kingdom's financial system.
It's exactly right, in the sense that interoperability is an incredibly high priority for the central bank digital currency. So if we were to introduce one, absolutely it would need to be very interoperable. Is it a significant ask? Well, not actually that much of an ask. I mean, if you consider the interoperability between bank accounts at the moment, since faster payments was introduced, it's now possible to actually send money very, very quickly within the banking system. So it's quite possible to do this within existing banks. And so the Bank of England, at the very least, could plug into that system and ensure that there was interoperability that could exist from that. And that's even without sort of trying to build new infrastructure to try to improve it even further. So yes, interoperability is incredibly important and is necessary, particularly with limits, because you don't want to be bumping up against limits. And also you might want to be sweeping balances off into interest paying accounts, of course. And you may want to be doing that automatically. So you may want to not have to think about that. You might have a rule that you might want to set up in your wallet saying, if balance is greater than X, then send money to account Y. And similarly, if I'm about to go overdrawn, then bring money in from account Y into my wallet in order to make sure I don't go overdrawn. So all of these things you may want, so that we call this programmability, sort of setting up payment rules within your wallet.
So not the bank setting up the programmability, but myself in my wallet through my provider.
That's right. That's right. Your provider will provide you with the facility to do so, but it'd be your choice of how to do it.
Ganesh, how exciting do you think the programmability elements are?
I think one example of this programmability, I understand it could be potentially to use it in smart contract sort of features. And of course, the smart contracts are basically predominantly used in kind of blockchain systems like sort of Ethereum, where you can essentially use these smart contracts to kind of mandate like transfers of tokens when certain conditions are met. So it's a bit like programming code on the blockchain, but essentially you could use kind of these innovations to kind of design kind of regular payment contracts as well. But I think like these sorts of applications that we see on the Ethereum blockchain, it's difficult to say whether like a digital pound could be involved in some of these like decentralized finance applications. It'd be interesting to see what this programmability features could involve. When I speak about decentralized finance, I refer to these things like decentralized exchanges where investors can trade, say, Ethereum for other tokens like stable coins, and these prices are kind of algorithmically determined without needing kind of your traditional market maker in like a limit order book, for example. So there's a lot of these like kind of innovations in decentralized finance that utilize these smart contracts to essentially automate some of the pricing and other aspects of these contracts. So, but it's hard to say kind of how much of these things could be replicated like with digital pound, like whether so I understand this programmability features could involve like some smart contract applications, but I'm not sure whether these are the right sorts of applications or whether it's something else.
I can come in on just some examples because I know this programmability point is not always clear to people.
Can I ask a question for you to clarify when you do that, Jeremy?
Yeah.
Is it the instrument that's programmable, as in you're coding the pound, or does the digital pound is it able to be used in a programmed context? Because I think I don't want my pounds to be,
No, it's the latter. And that's a very
bad use of language. Again,
exactly. It's a very important distinction to make. So it's not trying to restrict the pound at all in any way. In fact, we want to do the opposite. We want to make sure it's completely usable. This is simply a way in which you can control your payments. So how to make payments, conditional payments. So this already exists in the banking system, but we don't think of it like this. So whenever you make a direct debit or a standing order, you have a rule that's based, and your bank operates that rule for you. So for a standing order, it's a certain amount that goes out, and you may pay a relative or whatever it is, a regular amount of money, and it goes out of your account on that particular day. A direct debit is more variable than that because it might be a utility bill, but then it can vary at the decision of the utility provider. So all of these are rules. These are basic forms of programmability in payments, and so you could do very similar things potentially with a digital pound. But you can go further than that. So, for example, you can have things like delivery versus payment, which is quite useful for all sorts of reasons. So what do we mean by that? Well, if you get a parcel delivered to you, you bought a parcel it arrives on your doorstep, a photograph is taken of that parcel on your doorstep, that triggers the payment to take place. So you don't pay for it until it's been delivered. There are versions of this that happen in the wholesale market, which is I buy a financial asset, I only pay for that financial asset when I receive that financial asset. So that exchange happens simultaneously, and that takes out the credit exposure from both sides. So that's another form of programmability. So all of these things are potentially enhancing. Being able to pay for things only when you get them delivered can also benefit businesses. So if it's small businesses involved holding the digital pound, for example, they may be able to, when they're providing inventory to others, so this is a form of trade credit, if you like. So small business provides some goods to a supermarket, for example. The supermarket tends to pay very late. So they have to wait months and months and months for their payment to come through. Well, wouldn't it be neat if that payment came through earlier in a programmable way? So all of those things are potential cases for programmability with a digital pound.
Super. And quite exciting. So this is really a way in which the PIPs can distinguish themselves and compete with each other, as opposed to the direct debit scheme, which is a sort of nationwide, bank-wide effort, and quite a multi-year one, I think, to get there. Let's go back to stable coins. So we've had unstable stable coins, not necessarily backed one for one by anything. And there is a potential for future stable coins, which are stable and backed. What would be the point of a properly regulated, properly backed, stable coin if we've got a CBDC? And I throw that open to either of you.
I'd be happy to go first, but our view in the Bank of England actually is you could have both. They could coexist. We call it coexistence, and it's because you might get innovations in stable coins that you might not get in CBDC. So we're not close to the idea that the private sector could come up with something that could have benefits as well as the public sector. But we want any stable coins that do emerge to be safe. They need to be safe, first of all, in the backing assets behind them, so that if the stablecoin is sold in large quantities, there isn't some sort of fire sale going on with the backing assets. I think Ganesh has already alluded to that risk, and that will cause destabilization. But also, we want to make sure that they're interoperable. So at the moment, most stable coins have some sort of frictions with redemption. So if you try and sell your stable coin back to the issuer who's issued it, you find that there's a fee involved. Then they say, we'll get back to you tomorrow, maybe the day after. And by the way, don't come to us unless you've got at least $100,000 or whatever it is in order to sell back to us. So because all those frictions with the issuer, the only way you can really sell this thing practically is in the secondary market. And so you need to find a buyer. But of course, if there are blockages within the secondary market, then you might find that actually when you come to sell it, it's not worth £1 anymore. It's worth a bit less than that because there aren't many buyers around. Or similarly, it might go above it actually if there's a shortage. So if you need to get hold of that particular stable coin and there's a shortage, it may even go above £1. So for all those reasons, the backing asset reason and the frictions reason, you may get things trading away from par. So that's why regulation is needed. You need to make sure that if these things exist, they actually are interchangeable with other forms of money, and that's the regulation that we're working towards at the moment, and plan to publish something later this year on that regulation.
So would they, I mean, to the extent that the thinking is finalized, would they be fully fungible immediately and exchangeable at par, just like my Barclays pound is for your Monzo pound?
That's the idea. So the Bank of England's regulation, I should clarify, is for what's called systemically important stablecoins. So this is sort of breaking stablecoins into the small scale ones, so to allow innovation, and then these are the ones that might be used for everyday money. Now we don't have any of those that exist at the moment. There are no large scale ubiquitous stablecoins out there. There was a project that was that some people might remember some years ago, where Facebook attempted a stablecoin which went by the name of Libra, then turned to the name of DM, but then subsequently was abandoned, and that would have been quite large scale. When I say quite large scale, you just have to think about the number of customers that Facebook had, about 2.4 billion, I think, at the time. The largest banks in this country have of the order of millions of customers, not billions of customers. So that's the reason why so much interest was taken over Libra and DM at the time. But such a stable coin, if that was used on a regular basis, then that would be captured. A very large scale stable coin would be captured by this regulation that we're thinking about.
But the economic model for Libra DM would be effectively dead under the proposals that you're putting forward, perhaps quite rightly. I just wonder what kind of economic model a stablecoin could have in the future. And one could say, well, it's not your problem to worry about it, but arguably it is your problem to worry about anything that might become systemic if it's not economically sustainable on day one and it grows big. It's going to tax users at some point. But I'm going to turn to Ganesh. What excitement do you have or not about stable coins, proper stable coins?
Yes, so this is an interesting question. I think one of the key issues is what stable coins are used for. So they're still predominantly used to speculate on cryptocurrencies. And so I think that, for example, like even PayPal recently introduced like a PayPal stablecoin. And I mean, the main purpose is to facilitate trading in Bitcoin and Ethereum and other cryptocurrencies. So there's still very little sort of direct competition for sort of retail payments at present, although stablecoins could have more of a role to play in emerging markets where they have very unstable macroeconomic conditions, high inflation, and essentially there's no confidence in the sovereign kind of monetary policy. So in that case, stablecoins could enter the payment, be used for payments and as a savings device in emerging markets. I think that's not an issue for the UK. But there's still this tension that if it's used basically to speculate on cryptocurrencies, then again, there could be some disintermediation there if a lot of if there's a lot of usage of stable coins. But on this intersection between CBDCs and stable coins, I think is very it has the potential to improve like stability of stable coins. So stable coins main issue is that their backing includes like a lot of assets that could fluctuate in value. And so when you have this kind of periods where there's sell-offs of the stable coin issuers assets, then that could then lead to decline in the stable coin issuers reserves. And then you can have these kind of very traditional bank run type of risks where there's a lot of redemptions of the stable coin and the stable coin issuer runs out of liquid reserves. And so they'll have to abandon the peg, and then you essentially can no longer redeem at par. So that's kind of the biggest risks faced by stable coins. And so if a stable coin is backed by central bank reserves, like through a CBDC, then that should mitigate a lot of these run risks. And so I think that's also a potential benefit of having CBDCs, is that you could improve kind of the backing of stable coins as well. But I think kind of it's a little bit separate to the discussion on CBDCs. But I think another very interesting future for stable coins is their use in kind of foreign exchange trading. And so this is kind of looking ahead, but there's already sort of stable coins that target the Euro USD exchange rate, for example. So you actually instead of trading in the euro dollar market, you can now trade in a euro stablecoin, dollar stablecoin market. And so these markets, I think, have a lot of potential because they rely on different technologies, these kind of automated market makers or decentralized exchange technology. And so this is kind of another potential benefit of stable coins, that you can essentially change the way we conduct financial market trading. But this is, again, a little bit separate to the discussion on CBDCs. But hypothetically, if foreign exchange trading starts to utilize a lot of these stable coins, then that will again impact sort of digital currencies because of currency competition, right? So if you have like a lot of increased usage of stable coins for even foreign exchange trading, then how that would compete with CBDCs would be, I guess, definitely an issue. But I think, yeah, those are some of the sort of interesting, kind of more like forward-looking things to consider with stable coins.
But at the moment, they're just introducing another layer of exchange risk and another closed loop into the system, as far as I can see, and a pretty weak one at that. But taking it back to the more proverbial, just the day-to-day, me in 5 years' time, why would I use a CBDC, Jeremy? I've got MasterCard sending me stuff. I've got Monzo advertising all over the place. I've got Barclays here and there. I've got my old pounds. Why do I suddenly want a CBDC wallet?
So it depends on who you are. So it may be you like public money. So there are people at the moment who use cash at the moment because they want public money rather than private money. So you may be someone like that, and therefore you want to hold central bank money. So that's one reason. Another reason might be that actually the central bank digital currency ecosystem, so the platform that we've generated, has generated innovation that you've not seeing elsewhere, because there's this sort of new types of player who are coming in offering different types of service, and that may be one reason why you're wanting to use that. Of course, that may then trigger further competition and other forms of payments. The banks may react to that and may try and replicate it, and I'm sure they probably would try and do so. But there may be innovative advantages, and that programmability that I mentioned earlier may be one of them. You might find all sorts of benefits, easily splitting of bills and things like that. So you have automatic money when you have to make a payment, and there's a bunch of students in a house and they've all got to split the bill, and it's all very easy on their wallets to do so. All that kind of thing does kind of exist at the moment, but maybe could be easier. So for all those reasons, you may find CBDC better for you than traditional money.
And of course, as you say, a lot of those things do exist, and many of the new sort of neobanks and banking apps offer that. But what there hasn't been is a sort of nationwide campaign, and it's very difficult to conduct a nationwide campaign these days, not like when I was young, when there was one or two television channels and a radio station or two, and you got to everywhere you needed to get to. But I could see that really stimulating interest with that to happen. I'm going to finish this discussion, and we could carry on for hours and hours and hours. We haven't begun this. We could do the entire series, I think, on CBDC. But I want to ask, is a CBDC an instrument or a system? And I'd like you both to answer that question. Ganesh, what do you say?
My gut instinct is it's both. So it is kind of a policy instrument of the central bank. Of course, like as we discussed, there's no central bank rate on the digital pound, but even then, there's still this instrument of this threshold on the CBDC, so that itself can be a lever of the central bank. But as a system, I think, yeah, it speaks to this programmability discussion, that it can kind of enhance or innovate like financial services and go beyond just being like regular payments for goods and services. There can be many other functions involved. So from that point of view, it's more of a system. But yeah.
Jeremy?
I agree with Ganesh, it's both. And the instrument is a central bank liability. People may like that, as I mentioned, because they want public money, but it's also a system, a platform, if you like, an open platform for development. And so it is both. And that's why it meets both our objectives of uniformity of money and innovation as well.
And I suppose, cash is both instrument and system. There needs to be a system supporting cash for it to be.
Indeed, there's a distribution network that most people aren't aware of with cash.
Well, look, thank you both very, very much. That was fantastic. I'm sure we will revisit this topic on further podcasts. But thank you, Jeremy. Thank you, Ganesh. Thank you to the audience. But that's it for this Core Insights episode, brought to you by the Gillmore Centre for Financial Technology at Warwick Business School. I'm going to be back with further episodes exploring other big issues in fintech, and as I said, possibly CBDC again. If you want to keep up with the latest research, thinking, and issues in fintech, be sure to sign up to our Core Insights newsletter, and that will deliver all the insights you need direct to your inbox. A link will be in our episode notes, along with further reading from this discussion today, suggested by our wonderful panelists, Jeremy and Ganesh. And finally subscribe to this podcast, and then you won't miss the next episode in this FinTech series with Warwick Business School's Gillmore Centre for Financial Technology. Thank you.